but you also have to admit here that we are not getting the 24/7 by tokenizing something. Tokenizing it's a different infrastructure. You get that transferability, but 24/7. So how does it? Let's maybe take the money market fund as an example, because actually the answer to that question differs a bit what asset we are talking about. But in particular, money market fund today, why is there like a once per day a pricing? You have that NAV calculation, so the net asset value once a day, because you have all these underlyings and they are priced, and then once a day you have a price. There is no second or hardly any secondary market on money market funds today. Several reasons for that. Money market funds are extremely cheap. So, I mean, in the institutional space, 10 basis points or less total expense ratio. When you start trading those and you add a spread to that, it very quickly becomes not interesting. A 5 basis point spread increases your cost by 50%, right? So this is one reason why money market funds are usually just primary market. That being said, I believe now putting money market funds on a blockchain and having that transferability might open up ways to also offer in an easier way a 24/7 trading secondary market. So first, 24/7 issuance and redeemability is already kind of a thing that might happen and is happening already. And then, of course, also secondary markets. And that's something I'm also personally very interested in.
And welcome to another episode of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital assets industry. My name is Ian Simpson, and if you want to know what banks, hedge funds, asset managers, and others are doing in crypto and digital assets, and more importantly, how they're doing it, this is the place for you. My guest today is Alex Bechtel. He is Global Head of Digital Products at asset management powerhouse DWS. In addition to his role, he is also on the advisory board of stablecoin issuer AllUnity, and he is a lecturer at the University of St. Gallen, where he received a PhD in finance in 2021. Alex, welcome to RULEMATCH Spot On.
Ian, thanks for having me.
Alex, maybe just to start with, when we think about these big global players in the space, whether that's banks, asset managers, hedge funds, companies like DWS, what are kind of the driving forces, would you say, for what they are doing now versus what they maybe did earlier? Is it fear of disruption? Is it kind of fear of missing out? Is it some kind of unique insight into how blockchain, digital assets, crypto could be beneficial? What would you say from your perspective?
So I can't talk too much about what others are doing
Sure.
or the drivers. Ideally, I would say it's client demand, right? Or at least strategic considerations of being pushed into something because you have a fear of missing out is never a good, I'd say, advisor. So for us, when we decided to go into crypto and digital assets at DWS, which was around 2022, of course, there have been projects before, but like, let's say we communicated a strategy in 2022. It was, I would say, really driven mainly by strategic considerations and how we observed the market, and a conviction that we want to give our clients access to this new asset class, crypto, in a reliable and secure way. So there was around that time, that was also when FTX happened, for instance, and we believe it's our duty as a fiduciary asset manager to, whether we like or don't like crypto doesn't even matter at that point, but to provide access and exposure to that asset class in a regulated and trustworthy way. So that was for us the main motivation back then.
And that strategic vision has just grown and expanded and
yeah. So I'm quite proud of that, because we formulated that strategy in 2022 and we are still executing on it, and we're actually very close to kind of delivering on all those elements we promised. So I can maybe quickly go through those elements. Yeah, so our strategy has basically 3 verticals, I would say, which is at the same time describes our view of the market. So one vertical is cryptocurrencies. The second vertical is tokenized money. And the third vertical is tokenized assets, or probably nothing too surprising, right? But then what we did was basically two things. We looked at the size of each vertical. So how big are these verticals? So I don't know how big it was back then, but today it's crypto. So cryptocurrency is a bit more than 2 trillion, right? So 2,000 billion in market cap. Then you have tokenized money, which is mainly stablecoins, which is 310, 20 billion. And then you have tokenized assets, which on public permissionless blockchain, at least, is 30 billion. So we have 30 billion, 300 billion, and over 2 trillion. And the kind of relative size was the same 4 or 5 years ago. So it was clear that if we want to earn money, it's probably the crypto vertical, right? So we have to go there first. And that's exactly what we did. We started there. Then we moved over as a second step to the tokenized money vertical. And then last but not least, to the tokenized asset vertical. And we announced that already more or less years ago. So what we did then, it's already 2 or 3 years ago, we issued a Bitcoin and an Ethereum ETC. So that is like kind of crypto for us, right? There will be additional products that are going to follow. In the tokenized money vertical, we started a joint venture with Galaxy Digital and Flow Traders. It's called AllUnity, and it has become a stablecoin issuer, Euro stablecoin, Swiss franc. We already announced the Swedish krona. So that's kind of the second thing. And the third thing is we plan to issue a tokenized money market fund in the near future. So, and that kind of finalizes that strategy in the sense of we have now one product in each vertical, and now it's all about, of course, adding additional products, scaling, and then maybe start thinking a bit outside of that strategy. What else is there?
That's very interesting. I mean, I think that's very similar to how we see the market, crypto being the place where there's a lot of action, a lot of business opportunity to begin with. Those other things take more time to develop and grow. When you think about that progression from crypto to tokenized cash or tokenized money to tokenized assets, I know your background is a little bit interesting, coming from, as you were telling me before, even kind of gaming, where crypto was an interesting use case and very interesting. Now coming into a regulated space. What is kind of, when you look at the market in general, not necessarily at DWS, what is kind of the movement or the waves of progression in that sense from those different stages, crypto, tokenized money to tokenized assets?
Yeah. So banks usually have a lot of issues, or they're struggling with adopting crypto products, and that has always been the case. So banks have always preferred to talk, discuss, and think about tokenized assets and tokenized money. But there was just like 5, 6, 7 years ago, there was no market for that. So this is why the few ones that have been brave enough to actually build crypto products are the ones that are now the more successful ones in the digital asset space, which is why I believe it's a progression from a sense that since now also the tokenized money and the tokenized asset markets are growing, that it becomes a bit easier for banks to enter this market. Apart from that, I wouldn't actually call it a progression. It's just an enlargement of the space. So I don't think that by moving now towards tokenized money and tokenized assets that crypto will get less important. I think it's quite the opposite. And I also believe that the use cases for crypto, including Bitcoin, are different from stablecoins. For instance, at least my personal opinion now, Bitcoin is not a means of payment. It's more that digital gold, digital store of value, decentralized store of value. So it's not that stablecoins are directly competing with Bitcoins. I think they are more like they are fruitful for each other, right? Even more so for Ethereum, for instance, or all these programmable smart contract blockchains, because you actually need them in order to tokenize the assets and the money. So I think that's actually, let's say, they profit from each other, these verticals. But I would hope and I believe that it gets a bit easier for banks now to dive deep and hopefully start making profits in these tokenized assets and tokenized money verticals, and that they don't have to actually start with crypto anymore in order to even get a foot into the door.
But as you say, those who started early with crypto are a step ahead, kind of pole position for doing all of this. And I'm sure you see deep into what different banks are doing, and that takes a long time, as we all know.
Yeah, and usually what it takes is you need support, and that's cheap now, and many people will know that you need support from the top of the house. And it's, of course, everyone say, yeah, of course, yes. But I really mean it, right? So there are so many digital asset heads in banks around the globe that are like 4 or 5 layers away from the top of the house, and the top of the house is just not interested in the topic. And I've seen that now tens, hundreds of times over the last years. It's not going to work. And all the banks, asset managers that are really successful in the digital asset space, and successful not necessarily in a way that they have huge volumes and it dominates their P&L, but successful in the sense of being able to actually deliver products. It's almost always the case that those digital asset heads sit extremely close to the executive board or management board, and usually either the CEO or another kind of powerful person is extremely supportive.
Yeah, it has to be personal buy-in. I mean, for banks, always there's this thing lurking in the background, which is regulation, and that doesn't go away. We have now MiCA in full force and really in full force now in the middle of 2026, opening things up in one sense for Europe. What kind of role did that play? I mean, 22 was quite some time back, but what role did kind of MiCA and the thought on regulation play for DWS in this strategy?
Yeah. So DWS itself is not offering any MiCA relevant service in the sense that we would need a license ourselves. So this is kind of outsourced to our service provider. So for instance, for our crypto ETCs, Bitcoin and ETH ETCs, we have a custodian, which is an outsourced party who takes those cryptocurrencies into custody. For other products, there is, for instance, for our tokenized money market fund, there will be a transfer agent who is then actually issued tokenized fund shares, but so it's not ourselves. So that's so in that sense, what MiCA created for us is actually the possibility to enter that market, because there are regulated service providers that we can use. Because if they were not regulated or operate in an unregulated business, it's just not possible for us to even offer those products. And I would say the vertical or the business where we are most affected by MiCA is our stablecoin, so AllUnity, which again is a separate legal entity. We own a part of that. We are a minority investor there. And AllUnity, of course, had to get that MiCA license in order to be able and allowed to issue an e-money token. And that's something that worked quite well. We have been the first one in Germany, the first BaFin regulated one. And I have to admit, since we are usually also critical about the regulator, that worked really well. I mean, overall, the collaboration with BaFin works really well. They have been quite quick in kind of giving us that license, and also the collaboration since then is going really well. And a nice thing about MiCA, and when we talk about that MiCA part that is for stablecoin issues, because you have MiCA licenses for exchanges and custodians, right? But there's now specifically for the stablecoin issuers. That refers to another European regulation that's already, I think, from 2007, the e-money directive. So MiCA is basically referring to that piece of regulation. And what that piece of regulation allows us to do is not only issuing euro stablecoins or euro e-money tokens, but e-money tokens across all kinds of currencies in a very simple way, because the setup, the regulation doesn't change. It's basically a notification. You just inform BaFin about that. And that's something we are currently making use of at AllUnity. So we have started with the euro, of course. We've already issued a Swiss franc.
I was just going to say, yes.
Yeah, exactly. And the interesting bit is, since there is no regulation in Switzerland, it's basically a Swiss franc stablecoin that's MiCA regulated, so EU regulated. And we have announced, at least recently, that there will be a Swedish krona, and hopefully we're going to add to that. And that's something that's indeed enabled by MiCA, which I believe it's a really cool feature. Yeah.
Sure. Yeah, of course, and raised many voices within Switzerland that is even possible, but that's a separate topic.
And maybe let me add that if there had been a regulation in Switzerland, of course we would have gone for that, right? And that is also ultimately our plan. So if, of course, now we see, does it work out? Until now, it works pretty well. I think we are already the biggest Swiss franc stablecoin at the moment. And of course, as soon as there is more regulatory clarity in Switzerland, we are more than happy to comply. Yeah.
Sure.
And actually, I would also add that I'm convinced that you need strong Swiss partners in also. I don't believe that you can convince Swiss corporates to use a form of money that's issued by a German-based entity, right? You need a native Swiss entity with Swiss stakeholders in order to do that. So, and that's something we would work towards as soon as there is Swiss regulation.
But in one sense, that's the beauty of a market economy, so to say. Competition can push from two different sides and bring progress along the way. You mentioned working with the different partners for what you do with the stablecoin, but then also the other crypto products. We now probably will see, I don't know what your opinion is, that with MiCA now fully in force and the grandfathering period coming to an end, this will now change potentially some things in the market. Some quote-unquote legacy players that haven't been agile enough or focused enough to get a MiCA license will have some issues. How do you think that will affect kind of the broader market, and will that maybe leave more room for DWS or for others?
Yeah, that's a good question. I believe every intermediary traditional market participant has to think about what will be my role in a, now call it tokenized economy, call it a crypto-dominated economy, whatever, where, let's say, cryptocurrencies are really established as an even bigger asset class, and it's like totally normal to have a few % of crypto in your portfolio, and you have tokenized assets and tokenized money as a broader scale than we have today. So I believe every bank, every asset manager, every insurance company, every payment service provider has to think about what will be my role, and do I want to play a role, and what would that mean for me? Like extending services I already do, that's probably the most immediate thing, right? Banks are already offering custody today. Why shouldn't they also do it for crypto and tokenized assets? So that's I believe the easy questions, and those that are too late are of course suffering. And you already see those. There are, and I won't name names, but there are players who had great digital asset teams 5, 6, 7 years ago, which were all let go or left. And now they have to invest a lot to catch up, right? So it's costly to be early, but it's also costly to be too late, and that's the tough thing with innovation, right? To hit it on, get the timing right. But I believe the even more interesting question is, what about these roles that don't even exist in the traditional market? And maybe stablecoin issue is a good example, and that's also a discussion we had internally, because as a traditional asset manager, we actually thought that our role, and that's now an example of that first thing I mentioned, to extend our role into the stablecoin business by offering reserve management for stablecoins, because that's our core business. It's basically money market business. You manage the reserve, you issue a money market fund maybe. So that would have been, let's say, the easy answer. But then we thought about, look, I mean, there is now something like a stablecoin issuer. It's actually not immediately or intuitively clear whether banks should take that role, whether fintechs should take that role, or whether maybe even an asset manager should take that role. I mean, if you're anyway already managing the reserve, why not also being engaged in the issuance side? And I think that's the more complicated but the more interesting question everyone should think about. On top of how can I extend what I already have, are there maybe new roles that maybe allow me to get access to new clients or actually get market share I don't have today already. So see it as an opportunity instead of a risk or a threat.
For sure. And that brings me to a very interesting follow-up question, which is, under MiCA you have MiCA regulated entities as kind of a very broad term. Of course, banks doing business in crypto do need some kind of MiCA approval, authorization, but this regulation creates kind of a whole new category of quote-unquote MiCA institutions that aren't legacy FMIs, aren't banks, but are regulated at a very high level in the European Union. So what do you think that could, besides maybe stablecoin issuers, are there some areas where MiCA institutions can be kind of like the Revoluts of the next wave? What could this do for the market?
Yeah. I mean, we see first tendencies already. I first have to think, when you ask that question, about the crypto exchanges mainly, which are now moving, and that's a very classic thing that you see with that we saw with neo brokers, and now we see that in crypto as well. You have new players that usually have in the beginning a very thin tiny part of the value chain, and then of course they grab. The more successful they become, they go for more and more of the traditional value chain, and then of course the incumbents become nervous.
They wake up finally.
Yeah, exactly. So we see that with neo brokers in the traditional banking asset management industries. I believe we see that with crypto exchanges now in the more digital asset based crypto industry, and you could even make that comparison. So today in the new bank space, I would say traditional banks have, to a significant extent, lost the access to the end client. So this is usually the newer players with the fancy front ends and stuff, in particular in the retail space. I think in this institutional is a bit different, but retail clients. But the back end, the infrastructure, is usually still kind of driven and operated by banks. What I observe in the digital asset space is that the front end access to retail clients, mainly fintech native crypto players, so the Coinbases of this world, whatever. But what concerns me a bit is that also the back end is driven by fintechs and not traditional players, at least until now. That might change, but I mean, who are the big custodians? Look at the Bitcoin ETF, the BlackRock Bitcoin ETF in the US, right? Yeah. It's Coinbase who is the main custodian, and not BNY and others, and there are reasons for that, right? But I mean, I think incumbents really need to think about, if in particular when I compare to the traditional world where you already have lost the access to the end client. Here we are losing everything at the moment, right? Even the infrastructure part. And that's why I believe we should start focusing on what our role would be here.
And thinking outside of the box, and as you said, with issuing stablecoins, thinking how that can be maybe not what you would expect, but new opportunities at the same time. Just diving down into the AllUnity and stablecoins in particular, this partnership that came together, AllUnity, Flow Traders, Galaxy, big players coming together. Sometimes with big players, that's a challenge to put things together, but it seems like that's been quite successful. What has kind of been the echo from the market and interest from, say, banks, from other asset managers, from other fintechs, appetite for Euro, the Euro stablecoin to begin with, and others?
Yeah. So first, you are completely right that it's not that easy to pull a joint venture of three big players, to pull something like that off. And it was indeed a tough discussions we had to get to a framework that was a fit for everyone, in particular since we have with DWS a very traditional player, and then maybe at the other end of the spectrum with Galaxy, of course, more fintech digital asset native player. But that also is kind of the beauty of that partnership, right? Because it's not three players that do exactly the same, but it's very complementary. So we were kind of very happy when we had that setup done. I mean, we were one of the, definitely not the first one, but definitely the first of those more bigger institutional stablecoin issuers, or stablecoin-backed, institutional-backed stablecoin issuers. So the feedback was very positive in the beginning, and still is. Of course, what has happened by now is that it feels like 100 others are also doing their own stablecoins, so the situation is totally different now in the market. What I got wrong, honestly, in the beginning when it came to what would be our go-to-market strategy, we actually thought that we would be able to establish a Euro crypto trading pairs, or crypto-Euro trading pairs. Meaning, I believe like 20 to 30% of the global crypto trading goes through Europe. So my expectation was, if there's like a bigger institutional player coming, offering actually Bitcoin, Euro, ETH, Euro, whatever trading pairs, that those European traders would jump onto that. Because today they, of course, are mainly using US dollar stablecoins, which means they actually have to hedge their FX risk. Yeah. But what turned out is that it is apparently the liquidity and the kind of spreads you get in the US dollar pairs still dominate whatever you can offer in the Euro. And it's probably like it is sufficiently good that you are not moving over to Euro. You're rather probably hedging your FX risk and consume the liquidity and profit from the small spreads versus moving over to a Euro pair. And this flywheel effect that somehow Tether got going, and to a certain extent also Circle, but they had to pay a lot of money for it. I think Tether was in particular lucky to be early enough and have that flywheel effect. It's extremely, extremely difficult to create that artificially. So you have to pay exchanges a lot of money to get listed. In particular now, since everyone has its own stablecoin, they can pick and choose and open their hands, right? And then, of course, you have to pay market makers to provide liquidity. And what we realized is that has become extremely expensive compared to when we actually started thinking about that and defining our go-to-market strategy, which means we have shifted a bit away from that, hey, we want to be kind of that crypto first and then traditional payments later, to let's maybe bring those traditional payments in already, and instead of throwing, and we're really talking about you would have to spend double-digit millions on crypto exchanges and getting listed and getting liquidity on a range of pairs, let's use that money and focus a bit more on traditional payments, which is why also today we are talking, I mean, we're still listed on a couple of exchanges, but we are talking less to crypto exchanges and more to traditional players, including banks, of course, including payment service providers, but also including corporates. And we try to understand where and how can stablecoins actually solve real-world issues. And that's very much then the cross-border payment space. We have announced recently that we are building infrastructure for agentic payments, and we have first kind of pilot clients there. So that's kind of the things we are focusing on.
So many things that you discover along the way that aren't necessarily visible from the beginning, but that's part of the process.
Indeed.
When it comes to still on the kind of the crypto, but in the plumbing of it, right? You have Euro on Ethereum and several other blockchains.
Nine blockchains.
Nine blockchains. How do you think about that? Is it just which one can we find next and go further and further, or is there some kind of logic to what you think about when it comes to the actual technology?
Yeah. I am, in general, a fan of public permissionless blockchains, me personally. A big believer in those. It's not that I have anything against private blockchains. I just believe that many of the advantages you get from public permissionless infrastructures get lost when you go to private infrastructures. So this is why with AllUnity, but also kind of when we at DWS decide where to issue, for instance, our tokenized money market fund, the focus is very much on public permissionless blockchains. And then, to be honest, it's not that, of course, you do a due diligence. Those blockchains have to meet certain standards, which the big ones usually do. And then it's more about where are your clients? So what do your clients want? So in the end, everything we do is multi-chain. That's very true for AllUnity. This will hopefully also be true for our tokenized money market fund. And then you just start with one wherever you have your first seed investor or your first use case, and then step by step you add additional ones.
And my next question would be then, how does the regulator think about that? Do they have an opinion? Because we know in Switzerland, when we talk about digital securities, things that are really running on the blockchain, the regulator has a pretty clear view on how decentralized it needs to be and so on.
Yeah. So when it comes to stablecoins, we have that clarity. You are pretty free in choosing public permissionless blockchains. So there, the regulator is kind of not that strict in the sense of that it's not possible to use public permissionless, or even under MiCA. Indeed, I think it's a different story when we talk about securities, which in Europe fall under MiFID. I believe it's still, and we see that, possible to use public permissionless blockchains. What needs to be clear, and that's then a discussion you need to have with the regulator, you need to distinguish between a permissioning on the infrastructure layer and a permissioning on the asset layer. And usually what regulation requires is a permissioning on the asset layer, not necessarily on the infrastructure layer, which is why it's in principle possible to issue a MiFID security on something like Ethereum. You just have to be very clear to the regulator what is the setup, and actually you have to basically prove or explain that you comply with MiFID and all other regulations by permissioning at the asset layer. And that's the big difference between a stablecoin and a MiFID security, that you have to do that permissioning, that allow listing, right, which is not necessary when you issue a stablecoin.
We'll come back to that topic maybe in just a minute, but DWS, an asset manager, issuing fully backed stablecoins, if we use that term. There have been attempts at tokenized deposits from banks or deposit tokens, depending on how you use the term. What do you think of that? Those different flavors, so to say. Do you think there will be now competition coming from banks, or will fully backed stablecoins turn out to be a better form of money? We had some conversations with podcast guests who said, well, actually, this is in one sense an improvement when you know that every token is fully backed by assets versus how the system is fractional money today. What do you think about that?
Maybe jumping on that last point first you made, because I indeed believe that there is a bit of a misconception in the market what stablecoins actually are, and in particular a regulated one, and kind of how high the quality of those stablecoins is. So if you are a MiCA regulated stablecoin, you are fully backed by high quality liquid assets and or deposits. So it's a bit weird that we sometimes, when we talk about stablecoins, we say, well, it's a token on a blockchain which kind of can be sent peer-to-peer without allow listing. I mean, in the end, what a stablecoin is, it's an e-money token. It's the euro. It's regulated as the euro. We also don't call our bank deposits, well, it's an entry into a database and a liability of an issuer that can only be sent through institutions and only after allow listing. That's not how we talk about deposits.
That might make people scratch their heads.
Yeah, but that's kind of the comparison, right? So the stablecoin euro, e-money token in Europe is the euro. As much, it's actually from a regulatory point of view exactly the same as if you have a PayPal account and you have some euros on your PayPal account. And you would never come to the conclusion that you shouldn't call the euros on your PayPal account euro. You call them euro. So we should start calling stablecoins euro, because that's what they are. And then we should start, I would hope at least, appreciating that it's actually a very high quality of money. So as we know, of course, fractional reserve banking. The advantage with the banking system is it's you have the lender of last resort with a central bank, so up to, in Europe, at least 200K. You're pretty safe. But I at least wouldn't say that stablecoins are worse than that. Some might say it's even better. And I think that's an appreciation that hasn't happened yet, because stablecoins are, of course, coming from that pure crypto unregulated space. Right. And as long as we call them stablecoins, they will always have that reputation to a certain extent. And maybe since you ask about stablecoins versus tokenized deposits.
Or the move or the market for tokenized deposits, competition.
So the thing is, tokenized deposits are a very, very complicated animal. It's way, way more complicated than stablecoins, because it's tokenizing deposits basically means I'm moving the existing two-tier banking system, central bank and banks, onto a blockchain. But the rest remains the same, right? I still have kind of individual banks issuing individual liabilities, which they call tokenized deposits, that of course need to be interoperable with the liabilities that are issued, the tokenized deposits issued by other banks, which means you need the central bank as a settlement, clearing and settlement layer. And that of course means I have to move a whole market infrastructure onto a blockchain with all the players at once, in order for that to make sense and work. And then I still don't get a lot of those advantages and use cases that I get from stablecoins. And I don't want to say that doesn't make sense to move that on-chain. I actually think it does. I believe it might be more efficient to have banks and the central banks kind of operating unified ledgers, as it's sometimes called. But I believe it's something different than having a true digital bearer asset. And that's the really cool thing with stablecoins, that you have an kind of an open money protocol. It's something that is open to everyone, that everyone can access and use. It's like a native internet money, you could say, that allows me to do across borders 24/7, 365 days a week, in near real time, and at very low or zero cost, move value around. And Christine Lagarde gave a speech a few weeks ago where she said, well, all those advantages, or many of those advantages, we can actually get by a combination of wholesale CBDC and tokenized deposits. And that's something where I would not agree, because these wholesale CBDCs and tokenized deposits are not a digital bearer asset. So there is an important difference between those two.
Very, very interesting. And yeah, if you think bringing three institutions together, like with AllUnity, to issue a stablecoin is difficult, to try taking all of the banks in a monetary market and plus a central bank on top. Would you say maybe the central bank buy-in or activity is the biggest blocker to that happening, or?
So in Europe, at least, it's an issue, I would say. So the ECB is, diplomatically, I would say critical. You could also say almost hostile when it comes to stablecoins. Stablecoins overall, they're of course very focused on US dollar stablecoin, a potential dollarization. But going back to that speech of Lagarde, it was not only focused on US dollar stablecoins. It was basically saying, well, we don't need stablecoins. They are even a threat to financial stability and to monetary policy transmission. I would say the answer to US dollar stablecoins is not the digital euro, it's euro stablecoins, right? Which doesn't mean that the digital euro has a place, wholesale and retail. So, I'm very happy that they are working on that, but I don't understand why we can't, a bit similar to the US, also embrace stablecoins, because there is a product market fit. There's a 320 billion market out there. It's mainly US dollar denominated, and there is a reason for it, right? Because we are not really supportive, at least the central bank. I think the Commission is totally different. There are other EU institutions which are way more open, but of course the kind of regulator issue of the euro being against euro stablecoins or stablecoins makes it very difficult.
For sure. Transitioning now, shifting gears just a little bit from tokenized money, then on towards tokenized assets. You mentioned money market funds, and DWS has that in the pipeline. These are quite hot things, of course, these days. What is the motivation, maybe the driver at this point? Is it let's also be part of the game, or do you have some kind of client demand, so to say? What is driving this?
Yeah. We started all these three verticals I mentioned in the beginning: crypto, tokenized money, tokenized assets. We started thinking about those at the same time. And then the question was, what comes first, second, third? I already mentioned before, we went for the crypto because it was the biggest one, but we started working on tokenized money market, or not, tokenized funds in general, already in 2022, 2023. And we would have been able to run those things in parallel. So it wasn't that we were super busy with crypto and we couldn't do tokenized funds. We actually had 2 or 3 people working full-time on tokenizing funds. But we never kind of pulled the trigger in the sense of let's do it, because we just didn't see any market.
Yeah.
So no client demand, no product market fit. I'm still not 100% convinced that this is a huge market and a huge product market fit, but you at least see now first volumes, first client demand, and I understand some of the use cases for tokenized money market funds. Yeah, having that, since now the stablecoin market has developed and has grown, you have that on-chain yield, right? So I understand that there are use cases. This was different 4 or 5 years ago. So this is why we decided, okay, now, we have it anyway worked out already. Let's now start with money market funds. What we do is actually we create, we will do that out of Luxembourg. And our strategy is actually to create a platform. We start with a money market fund, but it's not exclusively a money market fund. So this platform, hopefully going forward, and if the market is there and if the client demand is there, allows us to also issue other forms of tokenized funds.
So going one step beyond, not just single products here and there, but developing a bigger platform.
Yeah.
Do you have some kind of models from the traditional world that you're following in order to target that? Kind of a bigger picture play with that, like I don't know. Yeah, some other examples that you've been targeting or copying, so to say.
So you mean from the traditional world? Yeah, it's actually, so the platform we are building there is basically a pretty standard fund platform in Luxembourg. It's actually interesting when you take a look at it. The difference between a traditional money market fund and a tokenized one, you look at the value chain today, is actually minuscule. There is one role. And I was also, when we started that project, actually thinking, oh, maybe we can get rid of a few intermediaries. It's not the case. So it's the same
not yet.
The same amount of intermediaries there. The roles change a bit, and it's for some of those roles possible to make them a bit leaner. But actually, the only difference between a traditional money market fund platform and one that enables tokenized money market funds is you have one role, which is the transfer agent, that is capable of managing the fund register on chain. So that's the tiny difference, but that then opens up a whole lot of hopefully nice features. So we're actually copying a lot from the traditional world with that little difference of the transfer agency. And then we'd rather now have to think about, given that we have now those tokens, what can you do when you think of a use case distribution kind of thing?
And I mean, looking at the tokenized money market funds that are already out there, we had one podcast guest recently who kind of said they really haven't lived up to the hype, so to say. They're there, but not many addresses and not much AUM in these products. Is that a case? You said you don't see a huge market for them right now. Is that because of any particular reason?
So first, I would agree with that statement, and I would even apply it to the tokenized securities market as a whole. I mean, money market funds, I would say, in a relative sense, are already kind of a success story compared to others. So, I mean, I've mentioned those 30 billion overall, which is nothing.
Right.
So I think, I'm not sure the securities market, the traditional one, is several hundred trillions. Right? So it's, I mean, not even a drop in the ocean, what we are talking about. And since we talked a bit about that we are in the space for quite some time. We all work also on tokenization for quite some time. So it's always a question, why isn't it going faster? Why doesn't it work out? And it's a difficult discussion. First, I think what we observe is that we are making progress. Every year it's a little bit more, but it's just extremely, extremely slow. Right? So when I compare to where we were in, let's say, the early 2020s, let alone 2018, 2017, there are definitely significant changes, in particular when I look who is now involved and who is working on the topic. But still, I mean, we are talking about financial market infrastructure. We are talking about basically a evolution, you could even call it revolution, of how our financial market works. And something like the SEPA payment system in Europe, which is only payments, took 15 years. And we are talking about basically moving the whole market onto a completely new infrastructure. So I think one thing we all need to have a bit more of is patience, because it's going to take way longer than also I would have thought a few years ago.
And the fact that you're building kind of also plumbing for this market that you see going forward, a fund platform, tokenized fund platform, does that mean that there are certain parts of market infrastructure, like an issuance platform or like a venue for trading the secondary market, that are still missing also, that hold things back?
Yeah, I would say almost everything's missing on a scalable and standardized and interoperable fashion. Right? You have, of course, including RuleMatch, right? Individual players who are doing a good job, who offer all the services that you need, but then you have the whole banking sector who is a kind of disconnected to a certain extent from those new, let's say, token enablers, let's call it like that. So intermediaries that allow kind of managing, trading, custodying tokens. So I believe in a very important step that's necessary in order to reach a higher kind of level of scalability is that banks are moving more into this direction. And there are several reasons why banks are a bit the laggards here. One is regulation. I mean, we had in the US certain issues with this SAB 121, right, during the Biden era. We still have, through the Basel capital requirements, that make it basically impossible for banks to take assets onto their own balance sheet that sit on public permissionless blockchains, which of course destroys many cases. And then, of course, general skepticism, risk, aversity towards anything that's crypto or public blockchain related. But I think as soon, and of course they are all moving into that direction, as soon as we have those banks, exchanges, also CSDs kind of being a bit more token ready, it can also get quick, right? It can be quite quickly, that adoption.
You mentioned earlier, and I said we would come back to this topic of AML, dirty little word, but when you have these tokenized funds and then they're going to be perhaps transferred around and traded and passed from one person to the other or one institution to the other, there is the question of how do you do the AML and how is that handled in an efficient manner, and does the blockchain help or hinder with that? And also, how does market infrastructure help or hinder with that? So if you're going to have these tokenized funds, but they're going to be transferred or traded, who does the AML? Does the end client have to be KYC'd, or does it just be the institution? And how do you see that potentially changing, and what would help and support that?
My hope, at least, would be that the infrastructure layer is and stays and will be permissionless, because that's where a lot of the advantages come from, to have a permissionless infrastructure, meaning we can use the Ethereum blockchain for all these things. We can use Solana and all these other blockchains, permissionless blockchains, while it will remain, and that's also a sensible thing to do, necessary to permission at the asset layer. And here, of course, the question is who does that and who needs to kind of allow list or whitelist or permission whom. And I believe that will be very similar to the traditional world, that you have an issuer. I mean, we are a B2B2C company. We usually don't sell directly to end clients. So what we usually do, we work together with distribution partners, and we, of course, have to do some kind of KYC due diligence on our distribution partners. So that tokenized fund might be listed on a money market fund platform, maybe even on a crypto exchange if they have the necessary licenses. And then those distribution platforms are obliged to, of course, do the AML checks on their end investors. Right? So it's pretty similar to how it works today, which, of course, unfortunately destroys a lot of the advantages you have from being on the permissionless infrastructure. So I don't want to kind of say that that's the final solution, because having that strong and strict permissioning at the asset layer, of course, makes it impossible that I send you my tokenized money market fund in a peer-to-peer fashion if your wallet address is not already allow listed. Right? So that is a kind of challenge we still have. However, if you are allow listed, that's actually something that's feasible, which is not feasible today. So a traditional money market fund is usually not sent or cannot be sent peer-to-peer. Right? You redeem it and then it's created again, which destroys a lot of these collateral use cases. So if you're in the institutional space, I'm an institution, you're an institution, that's kind of a limited amount of players, right? They can be allow listed, for instance, for our money market fund. And then we have created an ecosystem that allows these individual players actually to have collateral mobility and use money market funds as collateral.
And when you speak about use cases for money market funds, tokenized money market funds, do you have some unique or new use cases in mind for yours versus the others? I don't mean to compare and contrast, but it would just be interesting to hear.
Oh, I think it's pretty simple and similar to what others are aiming for. I mean, first and foremost, money market funds are on-chain yield. So since we have that stablecoin space, which is where it's tricky to earn a yield, hopefully it's easier to move into tokenized money market funds and earn some yield. Also intraday would be, of course, a nice thing to have. So that's, I think, the main use case. That collateral thing we have talked about is a good use case. And then from our very selfish point of view, it also means we can maybe distribute that fund through channels and reach client segments we are not reaching today. So imagine when all those crypto exchanges, which I hope is going to happen, are listing those MiFID securities, they will be able to list tokenized funds as well. And then I have maybe rather young investors or digital native investors with their wallet that then can invest into my tokenized money market fund, while those investors might never kind of open a traditional brokerage account and invest in the, let's say, traditional version of my money market fund.
When you mentioned intraday and some of those use cases, in the States, the SEC apparently is allowing and more moving towards 24/7 trading of things. How do you think Europe will respond to that? Will we still have kind of end of day pricing, or will we suddenly become even more always on?
Yeah, I would hope so, because that's one big advantage. But you also have to admit here that we are not getting the 24/7 by tokenizing something. Tokenizing it's a different infrastructure. You get that transferability, but 24/7. So how does it? Let's maybe take the money market fund as an example, because actually the answer to that question differs a bit what asset we are talking about. But in particular, money market fund today, why is there like a once per day a pricing? You have that NAV calculation, so the net asset value once a day, because you have all these underlyings and they are priced, and then once a day you have a price. There is no second or hardly any secondary market on money market funds today. Several reasons for that. Money market funds are extremely cheap. So, I mean, in the institutional space, 10 basis points or less total expense ratio. When you start trading those and you add a spread to that, it very quickly becomes not interesting. A 5 basis point spread increases your cost by 50%, right? So this is one reason why money market funds are usually just primary market. That being said, I believe now putting money market funds on a blockchain and having that transferability might open up ways to also offer in an easier way a 24/7 trading secondary market. So first, 24/7 issuance and redeemability is already kind of a thing that might happen and is happening already. And then, of course, also secondary markets. And that's something I'm also personally very interested in. And I'm still trying to find out to what extent that works for money market funds, in particular due to that price issue. As I'm observing also what you guys are doing, right, and see whenever there might be the first money market fund listed, and if it's possible to get that liquidity and get that set up so kind of cost efficient, in a cost efficient way, that it makes sense to trade money market funds in a secondary market.
That could be very interesting going forward. When we just think kind of big picture, I think of something that Brian Steele from the DTCC said recently, and they're doing quite a bit, or are looking to do quite a bit in the tokenized securities space, and that could be, I guess, potentially a big game changer if you have the big CCP tokenizing basically everything, the whole U.S. market. But he made the statement that in financial markets you basically have three things. You have a regulator, you have the asset, and you have the geography. And he said in the future, regulators probably won't go away, but potentially kind of the asset classification and the geography will become much more fluid or maybe go away. What do you think about that kind of vision or picture of the future?
And with regulator not going away, he was referring to kind of the infrastructure?
I believe so, like the kind of the ground rules, so to say. Whether that's within one country, with one region. Of course, Europe is a bit of a special animal, but then you get cross-geography and so on.
It's an interesting thesis. I would see exactly the opposite.
Okay. Make the case.
I believe, and I'm, of course, probably misunderstanding it now. Right? So I will make my point without actually intending to disagree. Infrastructure, going back to that point, that I would hope at least that infrastructure becomes permissionless, so that actually regulators stay out of the layer 1 or layer 0, whatever you want to call it, and try to regulate that. So I would say the infrastructure, the lowest layer, should ideally be global and just kind of tech, like the internet, basically. While anything that happens on top of that infrastructure, I will for quite some time be very kind of domestic, in the sense of you have domestic regulators that have securities regulation that differs a lot across jurisdictions. And I have a hard time thinking about how that would kind of disappear, only because things are now sitting as tokens on a blockchain. So even in Europe, the Lux regulator, when you want to issue a tokenized fund in Luxembourg, it's something completely different than when you want to do it in Germany or in Ireland, which has no regulation at all yet. So you already see within the EU, you already have those issues, right? So it's not possible that of course you have possibilities to distribute that fund throughout Europe, because we have that kind of resolved. But the issuance, at least, is something completely different and very, very national. And I don't think that these geographies disappear. So I would rather say, hopefully, the infrastructure is global, while the permissioning at the asset layer will remain very domestic for quite some time.
Okay, very interesting. And just thinking towards the future, we come now kind of towards the close of the conversation. We usually ask guests if there is something kind of in your mind that you've been observing, thinking about, considering, that most people aren't talking about yet. So not a buzzword, but something that maybe we should keep an eye on in the next, say, 12 to 18 months. What do you think would be interesting to check out or research?
That's a tricky question, because indeed your listeners will be very well informed. So I'm not sure if I can come up with something completely new. So I'm not too bullish, to be honest, about the next 12 to 18 months. It looks a bit like we are moving into a next crypto winter, and that usually takes longer than 12 to 18 months. So probably a bit of a kind of like low prices at the crypto front for the next 1.5 years. At the same time, 12 to 18 months are, in my opinion, not sufficient for that whole tokenized part to kick off. That's probably more a 5, 10, 15 year thing. So yeah, probably not too bullish. A take maybe that I'm observing that might not be clear to everyone is that I believe that business model that Tether came up with, now going back to that stablecoin topic, that's dead. I mean, there will not be any second Tether in the sense that it's sufficient to just issue a stablecoin and then wait for people to use it and become successful.
And collect interest and
correct.
tons of money.
Correct. I think what you need as if you are a stablecoin issuer today, you have to add something if you want to be successful. That might be an infrastructure, that might be banking services, then you might be a stablecoin bank, that might be payment infrastructure, I don't know, APIs that enable corporates to do agentic payments, whatever. But you need to think above and beyond the mere issuance of stablecoins if you want to be successful as a stablecoin issuer. And I believe in the next 12 to 18 months, it's probably even a bit too short, but afterwards there will be, my expectations are big consolidations of all these stablecoin issuers that are appearing at the moment, and those who are able to do more than only issuance, those will be the ones who are successful, in my opinion.
Will that depend on size, you think, or just people being innovative enough to find the right use case and the right niche? As far as size of players or size of issuers and so on? Yeah,
so size is, of course, very important for stablecoins, not only kind of the market cap and liquidity, but also kind of the geographical kind of spread you have, and then also the number of clients, so size and the network effects you create thereby. So size is definitely hugely important, and my argument is basically in order to get to that size, you need to think above and beyond issuance. You need to think about distribution and use cases and access. It's way more difficult to be successful as a stablecoin issuer than it was 5 or 10 years ago.
For sure. There probably AllUnity is pretty well positioned, but we'll come back and talk about it perhaps in the future. And spoiler alert, we will probably in the near future be having a conversation directly with AllUnity. So
very good.
That will be very interesting. Alex Bechtel, thanks very much. Very interesting conversation, and look forward to keeping in touch.
Yeah, thanks for having me.